Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
Hey, welcome back, Market Rebels. Happy Thursday, everyone. And that means it's almost Friday, and we need it after this week. What a wild week. And that made me think about hedging. In almost every single presentation, you'll hear me use the word hedging or hedge, roll, and morph, and they're all variations of hedges. But I've also found out that most people don't really understand the meaning of a hedge. They might have a basic meaning that's saying, okay, you're trying to soften the blow a little bit if you're wrong, try to get a little bit of an insurance policy there. That's partly it, but there's so much more to hedging than meets the eye. So let's take a look at the magic of hedging, because when you really understand hedging, it's actually kind of a weird, bizarre mathematical idea of how it works and what it can do for you if you truly understand how to hedge. And when you do, you'll start to realize that the essence of options trading isn't predicting whether the stock is going to go up or down, or even sideways for that matter. It's being able to trade the market, but hedge your opinion. So what does it mean to hedge a position? Well, this is a concept from financial risk management, and the center at the principle of hedging is that you want to avoid extreme outcomes. You don't want to stack your portfolio so that if the stock goes up, everything is just coming up roses and it's sunshine, everything's great, but if it goes against you, that you're flat broke or negative equity. Those are extremes. It's winner take all or lose everything. And unfortunately, a lot of times traders set up their portfolios in these ways. So you want to get away from the extremes, away from the tails, and move towards the center. And the way that you do that is to create a protective barrier or a hedge. And that's really a term, hedging, from the ancient farmers who would build shrubs, little rows of hedges to say, this is mine, this is my property here, keep out. And that's really where the term comes from. It's building a protective barrier. So what you're trying to do is to reduce losses at the expense of profits. It's always a trade-off. If you want to reduce the size of the potential losses, you absolutely must reduce the profits. But that's okay. This is why it gets down to your goals, which we've talked about before. Remember, you can't even define risk if you don't have a goal. So once you have a goal, you can say, well, if I can make 30% on this trade, but I'm only shooting for 20%, let's take the extra 10 percentage points and put it off onto a hedge. And now you've kind of customized your portfolio to your needs, not necessarily to somebody else's. Now, to really show the concept of a hedge, because there's really difficult mathematical examples and things that I think people just don't understand. So let me show you a really interesting one. At least I think it's interesting. And it's interesting because it actually happened to me when I was in undergraduate for a test that I was taking. And I fell into this exact situation. So I'm going to exaggerate it a bit just to emphasize the importance of hedging. But let's say that you absolutely must pass a quiz. All right, so we've got the setup here that it's something super, super important that we're trying to accomplish. And let's say that we have a really tough grading scale, that 90 to 100 is an A plus, you're going to pass with flying colors, or 89 or below is a fail. So already you can see the reason I set it up with this tough grading scale is that we've put ourselves into an extreme situation. This is the first thing that you should recognize. And if you're not recognizing potential extreme situations, this is where it will pay to work on it. Recognize when you're putting yourself into a potentially extreme situation. So let's back up a little bit and say, well, what am I trying to do? Let's go back to our goals. Well, my goal is to pass. It is not to get 100. Or I could rephrase it is that I'm trying to get at least a 90. If I get 100, that's great. That's just gravy, but I'm not required to. So again, this is why you have to have a goal. We have to say, what are you trying to do? And once you have a well-defined goal, you're going to see that decisions start falling into place. So here's our quiz. It's a matching quiz. And just to speed things up, I'm going to kind of take it for you. But here it is. 10 questions. So we look over here, we say, okay, a call option, and I say that is a right to buy. So that's F, that was easy. A put option is the right to sell. So that's B. Strike price, let's see, that is the exercise price, that's A. Expiration date is the third Friday. Long options, convey rights. That's going to be J. The OCC is the Options Clearing Corporation. That's a clearing firm, so that's easy. That's I. OEX is the S&P 100. Is that in the list? There it is right there. So that is C. SPX is the S&P 500. That's right there. That's E. And so far, I am feeling really good. I'm on track for 100. Until I hit question 9. And now I'm going formula for delta and formula for gamma. And I've got D and G over here to choose from. They've got these weird Greek symbols, these calculus symbols, and I'm going, you know what? I really have no idea. Or maybe I have a slight idea, but is it worth the risk? Is it worth the risk to maybe get the 80 and fail, which is what's going to happen here? Notice I have 8 out of the 10 that I'm absolutely confident are correct. So my whole goal is riding on these 2 questions. But wait a minute, maybe not. Once I realize that I can hedge my bet, what could I do? See, right now, if I guess D for number 9 and G for 10, and I'm right, then I get 100. If I'm wrong, I get the 80 and fail. Again, extreme situations. But if I'm sure that one is D and one is G, what could I do? I could pick the same letter twice. I could either pick D for both, or I could pick G for both. Now, what have I done here? And this is where some people would say, well, hang on a second. That's kind of weird. You know for a fact that one is wrong. That's exactly right. And they are scratching their head going, but wait a minute, you're trying to do the best that you can on a test. Why would you intentionally throw one of the questions away? And now it shows that you're not understanding a hedge. Yes, you're correct that I've also got one of these guaranteed to get one wrong, but I'm also guaranteed to get one right, and that's what I needed. And so now I've guaranteed to meet my goal. So by choosing the same letter, I have guaranteed the 90 score and the passing grade. And that is true. I have no chance of scoring 100, but that was never part of my goal. We're not even going to worry about that. So what we're doing is to what? Sacrifice the 100 in exchange for not getting an 80 and failing. And that's why I said before, if you're going to get a hedge, you have to give up some profits. That's exactly what we did here. As soon as I hedged, I knew for a fact I could not get 100. Big deal. I didn't need to. I hedged it so that I could meet my goal. All right, so that's a fairly simple example, but where does it get this weirdness to it that I talked about, these weird mathematical properties with a true hedge? Well, take a look at this. Let's do a very simple bet, let's say with a coin toss. All right, we're just going to do a coin toss for heads or tails. And let's say that maybe we're going to do this over and over, day after day, week after week, whatever. And you bet $1 on heads. Now, most people would think, well, that only leaves me $1 on tails, and I would have to take the opposite side. Well, if we did this over and over, because it's a 1-to-1 odds, 50-50 chance, we have equal amounts bet, in the long run, what's going to happen to us? It's just going to go sideways. Sure, one of us can be up. So you can see somebody got up $15 over here after about 400 tries. But in the end, this is after 1,000 tries. That red line is at zero profits and losses. We're just going to break even. That is an absolute guaranteed outcome of a random walk. Absolutely guaranteed. Well, that's not much of an investing strategy to say the best that I have to look forward to is to break even plus pay commissions. What happens if you hedge? And this is where most traders say, oh, I don't want to hedge because that's only going to reduce my profits. Not necessarily true. In the long run, if we do some proper hedges, we can give ourselves an edge. So watch this. Let's go back to the original setup. You bet $1 on heads. I bet over here in red $1 on tails. But if I'm allowed to hedge, what could I do? A hedge is betting against yourself. I could also place $1 on tails. And what I'm going to do is I'm going to change the risk-reward ratios. Now, it's going to get a little more complicated, or at least I'm not going to go into the complexities here, but that's the simple answer. We're just going to change the risk-reward ratios. So watch what happens. Notice I have $2 into the bet right now. I've got $1 on tails and $1 on heads. If the coin comes up heads, okay, my dollar swings over to here. We have $3 in the pot. And what happens? We had $1 each. Each of us bet $1 on heads, so we're going to split that. So we're going to split the $3. We each get $1.50. Well, if I put $2 into it and I get $1.50 back, I'm going to lose 50 cents. But that should only happen half the time. What's going to happen the other half? Well, the other half of the time, let's go back to the original setup. All money swings over to this side. We still have $3 in the pot, but notice I'm the only one in the pool. Now I've gained $3, and for having $2 spent, I gain $1. So this is what I said where we start to skew the risk-reward properties. So what could we expect? Half the time I'm losing 50 cents, and half the time I'm winning $1. We multiply those out, add them up, and look at that. I get a nice bright green expected edge of 25 cents. This is fascinating if you really think about it. When I didn't bet against myself, the best we can do is break even. But if I hedge myself, what can I expect over the long run? Here's the same 1,000 tries. Look at that. That is really, really fascinating. I have a long-term expected edge, just like a casino. So this is really the strength of the argument about hedging. Now, how you hedge and why and when are topics for the future, which means we have a lot to talk about. But right now, I just wanted everybody to at least understand what it means whenever I talk about a hedge and why it's so important. So if you change the way that you see hedging, you'll change the way that you see trading. And so for anybody who'd like to do that, we invite you to please get a free one-on-one consultation with one of our world-class coaches here. Absolutely free, 30-minute consultation. Pick your topic, and they can maybe that's something you'd like to talk about. What are some ways that you can hedge some of the trades that you have or trades that you like to do? So there's the phone number. It's 888-809-8058. Please give them a call. It could be one of the best moves you ever make in trading. So I hope that helps, and I'll look for you tomorrow. Thanks so much, everyone.